The false confidence created by constant analysis. Behavioral finance, cognitive distortions, and decision science perspective. Consider an investor. Reads 10 different analyses. Opens 5 charts. Watches 20 comments. Examines macroeconomic data. And finally thinks, "Now I'm sure." But are they really sure? Or does the information overload create false confidence? 1. Increased information equals increased confidence. The human mind works like this. More data, more meaning. More meaning, more confidence. But there is a critical distinction here. Increased information does not mean increased accuracy. This is called overconfidence bias in the literature. 2. Overconfidence bias. Many studies in the field of behavioral finance show that investors become more confident as their information increases. One of the leading figures in this field is Terence Odean. Odean's research shows that investors who are more confident trade more frequently, achieve lower net returns. In other words, increased confidence does not necessarily translate to increased performance. 3. Connection to the illusion of control. Constant analysis causes the brain to produce the message, "I am solving this mess." This is related to the illusion of control, as defined by Ellen Langer. Analyzing in an uncertain environment reduces anxiety. But this reduction is not real control, but psychological relief. 4. The information noise problem. Financial markets contain high uncertainty, randomness, complex variables. Consistent analysis often amplifies noise instead of the signal, assigns meaning to irrelevant data, leads to overinterpreting short-term movements, which increases the tendency to create stories. 5. Confirmation bias. An investor who constantly analyzes doesn't realize this. They often look for information that supports an opinion they already believe in. This is called confirmation bias. In other words, analysis is used not to seek the truth, but to reinforce existing beliefs. Result: decisions become defensive, not objective. Confidence increases, but flexibility decreases. 6. Decision fatigue. Constant analysis. Constant micro-decisions. Constant comparisons. Constant evaluations. This produces decision fatigue. As decision fatigue increases, emotional decisions increase. Impatience increases. Strategy breaks down. But the person still feels secure by saying, "I'm working hard." 7. How false confidence forms. False confidence usually forms through this cycle. Uncertainty increases. Analysis intensity increases. Anxiety temporarily decreases. A feeling of confidence develops. Large positions are taken. But the market moves independently. Ultimately, trust is broken. 8. What is true trust? True trust is not knowing everything, is being prepared for every scenario. True trust is risk management, is position size, is strategy simplicity. Constant analysis does not build trust. Accepting uncertainty builds trust. The deep truth. Constant analysis is often an attempt to suppress the fear of uncertainty, is a behavior to create a sense of control, is a mechanism to soothe the ego. But financial success usually comes from a clearer system, not more analysis. Conclusion: the false confidence given by constant analysis produces overconfidence bias, creates an illusion of control, reinforces confirmation bias, creates decision fatigue, increases excessive trading risk. And ironically, the investor who does the most analysis is sometimes the investor who acts most emotionally.